So is the lost worker phenomenon that we're seeing giving employees more power than ever? We've already seen strikes across a wide variety of industries lately, from carpenters in Seattle to bus drivers in Maryland to coal miners in Alabama. In terms of individual companies, employees are striking at Deere right now, Kellogg and Nabisco, while Amazon and Starbucks face unionization efforts. Is there a way to solve these issues to get the labor market back into balance? Joining me now to discuss are Mark Pierce, the former chair of the National Labor Relations Board, and Bill Rogers, director with the St. Louis Fed and former chief economist at the Labor Department. Welcome to you both. Mark, I'll begin with you. Is this just the beginning of a wave of additional strikes and similar measures we could see?
I think so. I think that what we have here is a situation where the pandemic has made clear that workers are vulnerable and are concerned about their health and safety. And they have also seen record profits in businesses that have not reached the pockets of the workers. Workers see that there is a shortage of labor and they have options now. And they're utilizing these opportunities to get better protections and get more money in their pockets to compete and to be on the level that they should have been given the profits that are being made in this country.
You know, Bill, it's interesting that we've seen wages rise. Even if you go back to before the pandemic, a strong economy, wages were starting to rise among, lowest earners. But this is just a totally different story now in terms of the dynamic. There's specific industries that are really hard hit. There's kinds of work that is especially difficult to fill right now. So how quickly before those workers come back to the labor force? Are they in other kinds of roles? And what does the raft of strikes tell you?
Well, you asked me several questions. Let me go with that, the raft of strikes. I mean, I think the raft of strikes tells me that this is just the straw that broke the camel's back, that starting in the 1980s, a little history here, but starting in the 1980s, there was a concerted effort to basically weaken unions, weaken organized labor. Then we also moved into accelerations in terms of globalization and also technologies into the workplace. Prior to the pandemic, people were, the buzz was, is a robot or AI going to take your job? And so, and then combined with policy responses that were not as strong in terms of supporting workers or supporting their continued growth in their share of workers' compensation, their share of labor share, it's called. And so this is really the rooster, the chickens come home to roost, so to speak, here. And that, as my colleague here just spoke, I mean, the tight labor market has shifted the nexus of power from employers to workers.
Mark, how much further does this go? We've seen Amazon paying now, I think, $22 an hour. Is it going to be just about wages because prices are so high? Is it about, other kinds of benefits? What would you expect as this continues to play out?
Well, it's not just wages, it's safety. It's quality of life. Workers have an opportunity, given the pandemic and during periods where they have risked their lives, to really evaluate whether or not this is what they want to do. This is a period where they're talking about the great resignation. Workers are leaving their jobs in droves and going to different areas where they're less vulnerable. Will this continue? As long as there's a desire to make a profit, there is going to be a need for a viable workforce. Just like in the 30s, when they had to ramp up production to combat the Depression, businesses had to face the fact that there has to be a partnership with labor. And that this is an indication that that's the direction that things have to